Well, today we're talking about conventional loans. So even if you think you know the basics, I'm sure you're going to learn something in this class. Jared is going to be teaching this one, so you know you're going to be up for some good information. For those of you that don't know Jared, I'm going to tell you a little bit about him. He is my mortgage partner, a branch manager, and a licensed CPA. So when it comes to analyzing income and structuring mortgage deals, he's definitely the guy you want in your corner because he's often in mine. He's been in the mortgage world since 2020, and he has a way of taking complex guidelines and making them actually make sense, which we can all appreciate. And just to round it out, he's a married dad of 5 kids under the age of 7. So if he can manage that level of chaos, he can definitely handle your toughest files. So make sure to reach out to him whenever you have any questions. One thing before I throw it over to Jared is if you do have some questions as we go along this class, please throw your questions in the Q&A and we will take those questions at the end. So with that, I'll let Jared take over.
Awesome. Thank you. Thank you. As a reminder, this is going to be a blitz class, meaning 30 minutes or less. Just get you some really cool information, hopefully helpful information. Um, so we're going to dive right in. If it can be less than 30 minutes, that's ideal. But we want to make sure you come away with hopefully a better understanding. We answer any questions you have. So we'll hop right in here. Um, First thing that I wanted to show was just the impact that conventional mortgages have in general in the mortgage environment as a whole. So this is a little breakdown that I found as far as statistics. Now, keep in mind, it says conventional is 43.6%. What you will find out there, if you were to go to Google or use AI or whatever, generally their responses are going to be showing conventional at a higher percentage, usually high 60s, low 70s, because they lump conventional as anything non-government, really. And so they would put these portfolio loans inside of that conventional bucket as well. Usually the statistics will. But what I wanted to do is I wanted to have it separated out because that's the data that I found. And I thought that would be actually really informative and useful information to kind of understand. So conventional mortgages still are the majority of the mortgages that are done out there. What that means is that you have Fannie, Freddie, or um, most of those that will do any non-government related mortgages. You have portfolio loans, and those loans, for anyone that doesn't know, are loans that the financing institution will generally keep on their own books. So they're going to do like a lot of these unique loan programs, things like that. Sometimes they'll be portfolio loans where they're not going to be selling them somewhere else. They're holding them on their own books. And so that in my mind is a separate category, although sometimes it gets lumped into that conventional boat as well. And then you have the governmental loans, the FHA, the VA, USDA, things like that, that is Ginnie Mae behind the scenes. What you do know as a trend as well, one thing that's interesting to highlight, and from 2024 to 2025, you can see that there was a small decrease in the amount of conventional, which led to an increase in the portfolio and government loans. And in prior years, that same trend holds true, where conventional seems to be over the recent environment creeping down a little bit as far as that percentage that it holds. And these other, whether it be portfolio or government loans, are kind of taking more and more of that. And anyone can speculate as to why. Obviously, when things get a little bit more challenging, maybe it's affordability, maybe it's just the uniqueness of people's pay structures, then different programs come out of that, right? If someone needs more room in their debt ratios, maybe they're going FHA, or maybe the flexibility that FHA offers is for that. Or I mean, there's different reasons for that being the case, but just kind of know that that's the trend. Anyone that sees my market update that I give every week with rates, you can understand that I like trends more than I like necessarily the individual number itself. It's helpful to kind of know where things are going because it paints a picture that you can actually utilize and understand. So conventional, still a huge player. Trend is going down as of late, but all it takes is a change in any number one of any variable that exists out there, and that trend can change pretty quickly. All right, so who might benefit from this, from a conventional mortgage loan? These are generally It could be someone that has a higher credit score, and I'll kind of come back to that piece of it. Someone that's doing a large down payment, and when I highlight the difference between this and FHA, I'll certainly highlight that as well. Real estate investors, because they allow for investment property purchases. If you're doing FHA, that's not what they're going for, although they will let you buy a fourplex or duplex. They're not letting someone just strictly buy it for an investment. And then lower DTI, so lower debt to income ratios, because there's less flexibility than maybe FHA might have with someone's debt to income ratio. Different types of properties that they'll go for. Anything 1 to 4 for primary residence. You can have a secondary, second home, or an investment property 1 to 4. So more flexible certainly than FHA is going to allow you to do, or some government related products, but it's also not going to get you the bigger 20 plus unit complexes that some people try to get as well. So keep that in mind. All right, so this is actually an extremely important element. So I'm not going to dive into the loan to value portion, but there's a matrix. If it's a single family home, you have to put at least 5% down, or there's different things that boil into that. But I'm not going to go so much into that because I really want to kind of highlight some LLPAs. They call them LLPAs. They're loan level pricing adjustments, and they come from like Fannie Mae, Freddie Mac behind the scenes. We'll be looking at the Fannie Mae side of the loan level pricing adjustments that they provide. But essentially what they are is, I'm actually going to open it really quickly so I can have it in here at the same time. Where is it opening at? Let me find where it's opening at, and then I can show it to you. Let me try this again. There we go. There we go. There we go. So I was actually reading through it a little bit earlier, and I think this is a great little, it just says it perfectly. So LLPAs are assessed based on certain eligibility or other loan features submitted in Fannie Mae's loan delivery system, such as credit score, loan purpose, occupancy, number of units, product type. So essentially you have a situation where Fannie Mae is structuring on different fees, loan level pricing, let's just call it fees instead of adjustments, where they're going to increase the fee based on certain characteristics of that loan. So if I go down here a little bit,
Jared, can you make your screen or just make
zoom
that
in.
zoom in? Yeah.
Yeah. Does
Perfect.
that look a
Yeah.
little better, or even more?
Yeah.
Okay.
No, that's great.
Okay. So what you end up with is this matrix that looks pretty intimidating to start. But essentially what it's doing is, so this is for, purchase loans, and then it's comparing credit score to LTV. So you have the LTV at the top here, so the loan to value ratios, and then you have the credit score here, the credit score buckets. And so let's just start right here, 95%. So let's say someone puts down 5% the minimum, right? So we're going to start in this bucket, and they have a really great credit score of 780. That means their pricing adjustment for that is 0.25%. But let's take a couple steps back because it's challenging to know what even that means. So what I wanted to highlight is how lenders get to the rate that they get to in general. So the first thing that happens is everyone generally ends up with the same, what's called the raw pricing, meaning nothing has happened to this. Let's for illustrative purposes, let's say that raw pricing right now is 5%. So let's say 5% interest rate that was the raw price, no cost tied to it at all. Well, if you start at that raw pricing, the next step that you would take would be these loan level pricing adjustments. So let's say now that 5%, based on what we just the little exercise we went through, that 5%, instead of costing nothing to get that rate, now it's going to cost the borrower 0.25% to get that rate. And the way that translates to a dollar, stick with me, is you take that 0.25% and you times it by their loan amount to end up with a dollar figure. They call these, if you talk to your borrowers or looked at their loan estimate, they're in the line item discount points. They call them discount points. So it's going to increase those discount points or the fee. So let's say that there's that one. Okay, so they're in a situation where they're in this little column here. They have great credit, so they're only going to be hit by 0.25%. So that 5% is now going to cost them 0.25%. Now you come down here to another bucket that has some other attributes it wants you to consider if they're applicable or not on the file. So let's say, again, we're going to stay in that same same bucket, but let's say that person's buying a condo. So the second one here, they're getting a condo. Well, what that means is they're going to tack on another 0.75%. So that's going to bring us to a total because it's in addition to, you're going to add on the quarter, 0.75, you're going to end up at a total 1%. So now that 5% rate that they're getting is going to cost them 1% in fees to actually get that rate, just off of these loan level pricing adjustments. And you'll see that they have different pricing adjustments. I mean, freak, look at this investment property adjustment, 4.125%. So I don't know if something's telling you that they don't love, anyways, investment property is not cheap. And when we say that, when we mention mortgage fraud being as prevalent and being a big consideration in when we're talking to borrowers and that intent on what they're going to use that home for, the reason that that's so important is because there's a lot of fraud related to how can we avoid this 4.125% fee? Well, the way you avoid it is you buy the home as a primary residence. The problem is if you don't intend to occupy that home as a primary residence, that's fraud. But you can see the incentive, right? Because fraud has those different characteristics, one of being incentive. The incentive being to commit fraud, you eliminate a huge fee. So obviously when we're talking to borrowers and when they're buying different properties and maybe they're going from a single family home, they go over and they try and buy they're now trying to buy a fourplex, but they're going to keep their single family home. It just raises flags. It doesn't mean it's not legitimate, but it means you got to have some good like what is the reason, and not just it's an investment property, because then you need to classify it as such when you're buying it. So kind of keep that in mind, that that's where they start with. And then you might think like, okay, well, if every lender that's doing a conventional loan has to follow these LLPAs, we started with raw pricing that everyone is pretty close to start every lender, and then you have these LLPAs that they're all following, then why is shopping for a rate even a thing? Well, the reason it is because then lenders go from there and they build in their margins, right? So how are they going to maintain keeping the lights on? What's their structure like? What did they focus on as a company? So how much are they going to bake in to raise that rate higher? And that's where the variability comes in a lot of cases, is that margin piece, or the lender piece in specific. So hopefully that's clear as mud here. I'm going to drop back over
One thing
to
before you take that,
Peter.
or
Yep.
just
Oh,
to mention on that,
yeah, I don't even
is
know how to get
we
back
were
to it.
focused on the 95% loan to value, and I just want to make sure um, people know on an investment property, you
Oh,
can't do
sure, 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 sure. Yeah, yeah,
that.
yeah, yeah, yeah. If it's an
Why they
investment
have
property,
it
it's
listed
obviously going to be,
there
yeah,
is
yeah,
anyone's
yeah.
guess.
Who knows? But obviously, the lower that, like, you can get to certain situations that even if you come up here, it's a little bit more stark. The more money that someone puts down to an extent, and I can point out another little weird little nuance. Um, but the more money you put down, generally, the lower the LLPA fee is going to be because you have so much skin in the game. The weird little thing is, and I don't know if you've heard, like I've told some real estate agents this because their clients are I've walked through it with their clients before, and it's been kind of a weird little nuance. But you'll notice that in some situations, like if you look at this one that we were focusing on, if they put 5% down, they get a 1/4% fee. But if they put more money down and they end up right here where they're putting more money down, the fee is actually higher. And you might wonder like what the crap is going on. Why would the fee be higher? They're putting more skin in the game. It's because you're breaching down. In this case, you're getting close to, and in this case, you are removing mortgage insurance, which increases their perspective of now there's more risk because there's not that mortgage insurance. So they charge for that risk accordingly. So if someone could get down to 75% and eliminate it altogether, it might be pretty beneficial. Anyways, just food for thought there. I don't want to dive into this table anymore. It's hurting my head to look at all these random numbers. All right, so I think that's everything. They obviously have tables for private mortgage insurance as well. Not going to dive into those ones, but again, they factor in different risk factors that they consider in getting to the percentage for mortgage insurance as well. And I'll come back to these things real quick as well. What I wanted to hurry and highlight. So I grabbed this is not a loan estimate from anyone in particular. This is just a random one. It's actually the one you can grab off of CFPB directly. And so I wanted to grab a quick little snapshot so you could see what I was illustrating in those tables before. So you'll see right here that it has points, the $405. That's what I was talking about with those LLPAs and things like that. And then you see these other fees. When what's really important is sometimes you'll have a buyer that is certainly when they're shopping around, they may, I would imagine, come to you with questions. Because if you're shopping lenders, probably one of the more reliable sources is if someone knows it's not a lender that maybe can help them decipher it. So maybe they think that they're going that way. But what I always highlight it as, everything in this bucket is a lender fee, right? It even says origination charges, it's a lender fee. So what you'll see sometimes is there'll be a large origination fee here. Let's call it this underwriting fee, 1,097. And maybe they don't charge many in points because they're getting their money in some of these other fees. Similarly, with some of the fees down here, depending on what's being charged, sometimes lenders charge for the credit report fee or any other number one of these itemized fees that maybe another lender doesn't charge itemized for that fee. But again, it's just important to kind of, in order to do apples to apples, how someone structures it is important as well. So if another quick little nuance, if one lender is saying that they're not going to need as much in their escrows as another lender, that shouldn't really be considered, because at the end of the day, they will need money and it's not a lender specific thing. Like if one tries to inflate or deflate the numbers accordingly, I mean, it's just a game at that point and it shouldn't be done that way. Really, you're looking at this box and some of this box to kind of determine how to adequately look at that. So, all right. Minimum credit score for conventional loans. Effectively on November 15th, there was no more minimum requirement. However, just because there's not a minimum doesn't mean you can still get approval for anything. So when lenders are doing stuff behind the scenes, they submit over to what's called AUS, Automated Underwriting System, DU. So they're submitting it over. So you have this application that was filled out by the borrower. The loan officer goes in, they're kind of tweaking some stuff based on the documentation that's provided. And then they're submitting it, all the data into a system for underwriting to give like an automated underwriting evaluation. That other automated underwriting evaluation, even though the credit score could be anything, it still factors it in. And so it still could not approve it, even if a credit score, let's say the credit score is 620, it's like, we don't like, in consideration with everything else, we're not giving approval for that one. Or the credit score could be 720 and they still don't get approval. I mean, there's lots of factors that go into a mortgage application beyond the credit score, that it's just kind of saying, the way that I read the guidelines as far as the credit score is, there's no minimum anymore. So it's worth a shot. You can always try, but it doesn't mean that it's a sure thing that if you have a low credit score, you're good to go. It doesn't work that way. And I'll even dive into how sometimes it's like, it can be painful to have that low credit score. So really quickly here, what I want to do is I'm going to highlight over the next couple of slides how the credit score in particular can change the impact of the mortgage in general comparing conventional and FHA. So if you look at this, all I really want you to focus on, so if you have this conventional is first column, FHA is this next one, is the MI amount. For this illustrative purpose, let's just look at the MI, so mortgage insurance. And we're going to compare from one to the next. So you'll notice at the top, we're looking at a 780 credit score here. You have mortgage insurance 9104. FHA's mortgage insurance is 219. So in this case, it's like conventional mortgage insurance looks great. You actually end up in every situation just better off. You have to bring a little bit more money because you're putting a little bit more money down. Interest rate may be a little higher, but it's offset by other factors in the loan, like mortgage insurance. So you end up with, okay, this is nice. Well, let's drop the credit score a little bit. So you have 720. Now you have MI being $162, so it's closing that gap. You have 219 over here with FHA, so it's closing the gap. You have a rate that is now higher. Why is the rate higher? Well, if you remember those LLPAs that we just talked about, that credit score is lower, so they're being charged more for that rate. So it starts to look a little less clear. It's like, oh man, that's not looking as crystal clear on which might be the better option, at least mathematically. And then if you drop the credit score even further, you drop it down to 680, you start to see it's starting to get pretty painful. And if you keep going down, it's going to get more painful. And although this one, so the difference would be obviously with conventional, once you get 20% equity in that home, you have the opportunity to get rid of that mortgage insurance. Whereas FHA, if you're only putting 3.5% down, that's going to be there for the life of the loan. So you do see, obviously, with FHA, a lot of people get that initially, if they need to, or even if it works out mathematically better, and then later on they may refinance to a conventional loan to get rid of that mortgage insurance. But you can see how things change pretty drastically. I mean, the rate's going to go up again. The credit score is lower, so it's impacting them. Whereas FHA, their mortgage insurance is not, like credit score is not a factor in determining their mortgage insurance percentage that they use. So things to consider, and the reason for highlighting this is sometimes people will ask, it's a common question for agents is it seems to be this notion that someone that may be pre-qualified or qualified first through FHA may not be as qualified as they would be if they were qualified conventional. Um, and I guess my pushback is sometimes it's not always that someone does FHA because they are needing more room in their debt to income ratios. It may not always be that case. There could be mathematical reasons that FHA beats out the other one. And there's certainly never a situation in which someone is more or less qualified to buy a home. Like if certainly the way that me and Monica do it with the way we do pre-qualifications, looking at all the documentation beforehand, if someone is qualified to buy a $400,000 home through FHA, they're just as qualified to do that, that even if someone else is qualified at conventional, then they're still qualified no matter what. Even if it's FHA or conventional, the qualification remains. And so they're both legitimate. They're both really good programs at buying the home. They just offer different advantages or disadvantages depending on the benefits you're getting. So, all right, I gotta speed up a little bit. I'm taking too much time. Hopefully it's useful though. Appraisal value acceptance. So sometimes you guys will see that homes are offered appraisal waivers, is what they used to be known as. So these are some things that can be considered. Generally, to get an appraisal waiver, there had to have already been an appraisal on that home in the past. Every one of the appraisals that get done conventionally, they're housed in a registration that Fannie Mae uses and relies upon in the UCDP. And essentially, they can analyze, and if sometimes if you're getting that appraisal waiver, it's saying that the value is supported based on all their analytics and the prior appraisals and things like that. One unit properties, there's some other stipulations. Principal residence and second homes, you can only do it if it's an investment refinance transaction. And then there's some other stipulations there too. But the only way that we know if a home gets an appraisal waiver or a value acceptance is they go into contract on that home. We can then run that address through the automated underwriting system and get that understanding. There's no way prior to them going into contract and doing all that we would be able to determine if they're going to get an appraisal waiver or not. So kind of keep that in mind. Allowable concessions. We've sent out some cheat sheets in the past related to this. Quick thing to highlight is the more money you put down on a conventional primary or secondary home purchase, the more concession percentage that they allow. So it goes less than 10%, 3% that they'll allow in a seller contribution, to 6 to 9. But it's very strict on investment properties where they are only going to allow for 2%. It doesn't matter how much money you're putting down, they're not going to change that figure. So got to be really careful with that. Sometimes people get hung up on that investment property one because it is a little bit lower than some of the other options. There we go. I don't know why I did that. Here's another little financing cheat sheet that we can certainly send to you guys if you want. Just reach out and let us know. But it just kind of gives some different fields and it's just a little cheat sheet, little reminder of some of the flexibilities that each program might offer, some of the things that makes it differentiate, whether it be the down payment required or how they treat foreclosures, how much time you have to have since your last foreclosure, different things like that you can kind of reference back to. And then we've sent this thing out in the past as well. I know that this is like not going to be clear. If you want the tip, so this is a typical buyer and seller splits. If you want this breakout, just let us know too. And some of the things that really stand out is some things that VA considers mandatory, like the escrow closing fee has to be paid for by the seller, things like that. So there's even nuance to that one as well. So, all right. Any questions while I was rambling on there forever, Monica?
Sorry, didn't get my mute button. That was all really good information. And I think it's always helpful to see how those loan level price adjustments impact pricing. And I feel like you could do a whole entire blitz
Yeah,
class just on pricing.
yeah.
Just a couple questions actually. What counts towards a buyer's debt to income ratio?
Okay, so we're just going to talk conventional. So on conventional financing, what's going to count is the mortgage payment for the home that they're looking to buy. So the home that they went into contract for, we're going to look at the total mortgage payment for that. So that's going to be principal and interest. It's going to be taxes and mortgage insurance and homeowners insurance, or and HOA. If there's an HOA, we're considering that as well. And then the like surefire thing would be anything on their credit report. So any monthly payments listed on their credit report. So it could be car payments, credit cards, any of that stuff. Sometimes, so it's a little bit trickier of an environment now too, because there's ways that people end up with debt that doesn't show up on their credit report sometimes, and it can be a little weird. And so we find it on the bank statement. So think like we always have to ask if people are using Venmo or Zelle, PayPal. Like there's ways to get debt on there. Like you can have, I think Apple, like Apple cards. A lot of times it'll show up on the credit report, but sometimes it doesn't, and you can see it happening on their bank statements, where it can actually be a debt that they're paying, like whether it be a actual credit card they got through Venmo to help pay for stuff that we would need to consider, or is it them just splitting the restaurant bill and we don't consider it. So some of the stuff requires you digging in a little bit more, but in general, it's going to be that mortgage payment, anything showing up on their credit report, which would include any other properties that they own that they have mortgages on. Even if they include, or if they own a property that they don't have a mortgage on, we still have to factor in their taxes and their insurance on that property that they pay. So there's some stuff, but in general, for most people, you're pretty safe looking at that credit report and looking at the home that they're looking to buy.
Okay, next question is, what do you guys think about the 50-year or 40-year mortgages? Will this end up becoming an option? So here's a chance for you to get up on your soapbox there, Jared.
I don't know. If you want in the land of opinion, I mean, mathematic. I think sometimes like what you have to do is you have to strip out the math. I get it, right? I think people are smart. People understand in general that like, listen, a 40-year mortgage, it's not going to math out as fun, right? There's going to be a lot of freaking interest on a 40-year mortgage, a 50-year mortgage especially. But sometimes having a place to live might override the mathematics a little bit with like, okay, yeah, the person is going to pay a lot more in interest. Trust me, I've seen a lot of like anytime anything is being done, there's a lot of social media stuff and a lot of people that seem to highlight a lot of the math behind it, but they fail to, and trust me, I'm a math guy, but I think sometimes you get lost in that and you fail to consider the real life implications of having a place to live, and there's only so many levers that you can pull for affordability. Lower the prices of homes, lower the interest rates, um, change the terms of the actual product, right? Which would be the years. And so any combination of those that can help someone afford, and don't get me wrong, I get it's crappy that that's a lot of interest, but if they can afford to buy the home and live in the home and raise their family in that home, in my mind, I'm all like, please do offer that as an offering to allow for people to have the opportunity, even if the math doesn't math is great. I'm sorry. Hopefully Dave Ramsey ain't listening to this. But sometimes having a place to live does matter because it's not like rents are getting cheaper either. So
Right,
yeah, there's my
right.
soapbox. I think that they should
Good
be
job.
a
Good job.
thing.
Good
I hope
answer.
so. Yeah, yeah, I hope so.
Well, our time is just about up. I do want to point out something that Jared mentioned earlier about his weekly market updates. If you are not subscribed to that, I would strongly suggest that you reach out and get signed up for that. Just send Jared an email, or you're welcome to send me an email, and we'll make sure that you get signed up for those weekly updates because they are really great. Like you can take from those and do your own social media or your own update to your own um, database. So really super helpful. Our next class coming up, I believe, is FHA, and we'll be going over that. So make sure to mention that to your colleagues if they're not signed up. Even if they can't make the class, we can still get the recorded version out to them if they have signed up for the class. So with that, I think we're done. We're good.
Okay.
That was
Okay.
awesome.
Yeah, it is 2:30. And the last thing on that newsletter, I'm not a salesman, you guys. I hate that. Like the newsletter, if I can make a plug for it, I'm not here to bog you down with just crap. So I'm not even sharing where my rates are at. I'm not even trying to sell where I'm at, which is generally lower than anything I'm showing. I'm just trying to show you a trend of rates because it can be so valuable to you and it can be so valuable to your clients to help understand where rates are going, where they have been. I'm
And
using
why? I love that you put in the
and
why there
why
too, kind of
I'm
like
you
what is impacting it.
yeah, and I'm using like um Mortgage News Daily to compile a lot of these rates, which they do a compilation of nationwide stuff of lenders all over. And so it's just meant to be helpful. It's certainly not a sales tactic. It really is hopefully just useful information that you can use and throw out to your database that can be great marketing and helpful information for them. This last week, I think it highlighted a 2-1 buy down type thing where it's just kind of going through a little bit of the math there based on those rates. So, anyways, little plug there that it's not a salesy thing. It's literally just hopefully helpful and even spurring some good marketing efforts on your guys' part as well.
Yeah, and those that have just responded to say sign me up, we will make sure that you get signed up for that. So,
Yes.
okay, we'll see you on the next one, everyone.
All right, guys. Thanks so much.
Bye.